Welcome back to our accounting cycle from start to finish. It's Professor Karn today going to illustrate step 5 of the accounting cycle, the adjustment process. So we pick up the first step here, step 5A, and that is to record all adjustments in the general journal. And they give us the adjustment data A through D here, and we have to record and prepare the adjusting entries in the journal. Then in step 5B we will post to the T accounts, and in step 5C we will prepare an adjusted trial balance. Alright, so it says here in our first adjustment, letter A, office supplies used during the month was $1,000. Recall back to our lecture video about supplies, prepaid rent, prepaid insurance. We want to focus on how much was used up or consumed. So they told us that $1,000 was the number. Alright, so let's go ahead and put our date here first because we're starting another page in the journal. And remember, it's at the end of the accounting period, so we have 12/31. So remember, we're using up supplies, so they're turning from an asset into an expense. So we're going to debit supplies expense. And for the amount that we used up or consumed, in this case $1,000. And then remember, we're consuming or using up and going to have to credit and reduce supplies. $1,000. Okay. So there's our first adjustment in letter A. And letter B states depreciation for the month was $150. Recall that we have to use depreciation expense and the new contra asset account accumulated depreciation for that journal entry. So we just go ahead and debit depreciation expense. For $150, and we have to credit our new contra asset account accumulated depreciation. Now, what we want to make sure that we do is they really didn't tell us what the depreciation was for, but if we look up at the chart of accounts, we really only have one accumulated depreciation account for equipment, and that's really the only depreciable asset we have, so we would just use that. So we'll go up and let's go ahead and put comma equipment there, and we'll go ahead and put comma equipment there. And I'm going to make this a little larger for us here so that we don't run that into the other column there. There we go. Okay, so again, depreciation is always recorded by debiting depreciation expense of the asset and crediting accumulated depreciation of the asset. Okay, then we get to letter C, 12/31, letter C. 1 month insurance has expired. Okay, so in this particular case, we have to find out, go back to our original journal entries in steps 1 and 2, and you can see here, if we go back up to look at this, if you look at the first, December 1st, the third one, we paid $1,500 for a 5-month insurance policy starting on December 1st. So, okay, so we have $1,500 divided by 5 months. So let's just write that over here, some calculations over here. $1,500. Let's make that a little larger for us so we can read it. Okay, so 1,500 divided by 5 months, and that comes out to $300 per month. And again, we've only had 1 month expire or been consumed or used up. So again, we would debit, in this case, insurance expense. And for the $300 figure, and we would credit and reduce our prepaid insurance. Okay, then finally we get to our last one, accrued interest expense. Accrued interest expense means that we have incurred the expense, but we have not yet paid it, so we owe it. So on the final one in letter D, we have to debit and recognize our interest expense for $50, and we have to credit and recognize that we have interest payable because we owe that interest. So there you go. There's the 4 adjusting entries. That concludes step 5A. Now what we have to do simply is to go to the T accounts. Now here is step 5B. And notice I brought over everything that we had from before. We can't forget what we had in the past from step number 3 when we posted our regular journal entries to our T accounts. So I brought all of them over. Now notice what we have to do here. We have to post all of our adjusting entries to the T accounts. And what I'll do here is I will pause the video here a moment, and I'll go ahead and post those for you. Anything that will be in blue will be new, and I'll go over it when I come back. Okay, I'm back with you here now, and what I did was I added all of the accounts that we will need that will be new, and they are in the blue font. And now we can go ahead and post the 4 adjusting entries to our T accounts. So in the first one we had a debit supplies expense for $1,000, so we'll do that. Okay, so we did that. Let me just get this last piece here to make sure that we got enough size there so we can see what we're doing. Okay, so now we have that $1,000 debit to supplies expense, and then we have to go up and we have to credit and reduce office supplies because we actually consumed and used some of those up. So let's go up there to this account here, and we credit that for $1,000. Okay. Now, the second adjustment, we had to debit depreciation expense equipment. So we'll debit that for $150. And we will have to credit accumulated depreciation for $150. Okay. The third adjustment is to debit insurance expense for $300, and we have to credit prepaid insurance for $300. And again, all the adjusting entries are in blue to kind of help you understand and identify those in this particular step. And all the new accounts are in blue font as well. And then the final one that we have to deal with is our interest expense. We have to debit that for $50. And we have to credit interest payable for $50. So we've posted all of them. And we have to then look and see what the new balances of the accounts are going to be. I'll leave the original balances in orange so you can kind of see from step to step how this works. And then I'll put the new balances if they've changed. Again, if they haven't changed, we won't impact them. or do anything to them, but if they do, I'll highlight them in a different color. Let's go with I'll go with green to highlight the new adjusted balances. I'll be back shortly. Alright, I'm back now after having balanced all of the accounts here. There really was only two asset accounts that needed to be rebalanced. Those were office supplies. You can see since we credited it for $1,000 in the adjustment process, now the current balance is $1,000. And then the prepaid insurance went from $1,500 on the debit side because we credited for $300. Now its current balance is $1,200. And then all the other balances that we have here, you can see were all the same. And then all the adjustments I just labeled in the green, highlighted them in the green boxes there because all of those balances are just what the one entry was when we put them in for the adjustments. So now we're ready to go to step 5C. And we just go over to that tab here, and basically we can do an adjusted trial balance. And what we have to remember here is it's exactly the same thing, the same format as a regular either trial balance or unadjusted trial balance. And the only thing we have to do now is use all of the accounts with their new balances. Okay, so let's just go through this together. So we'll just go in order. Remember, assets, liability, owner's equity order. So cash was $44,800. Then we have accounts receivable. For $2,600. We have office supplies. Its current balance $1,000. The new green number there, not 100, 1,000. Then we have the new balance of prepaid insurance. And that was for $1,200. Then we have equipment. And that was a debit balance of $9,000. Now remember, we're trying to list these in order of asset, liability, owner's equity. And we've got to remember now equipment now has an accumulated depreciation account that goes with it. So we will always follow that account, the plan asset, with the proper accumulated depreciation account. Credit balance of $150. Okay, then their last asset is land, and that has a debit balance of $16,000. So that concludes all of our assets. Now we can get to our owner's equity. Okay, so let's not owner's equity, excuse me, liabilities first. So let's see what we have there. The first one we have would be our accounts payable. $1,880 on the credit side. Then we have our interest payable. We have that as a new account after our adjustments. Interest payable, and that was for $50. Then we have our unearned revenue, and that was a credit balance of $1,400. Scroll down a little bit here for us. We're a little bit too far there. Don't want to do that. Okay. Then we have our notes payable, and that was $12,000. Okay, so again we had accounts payable, interest payable, unearned revenue, and notes payable. That would be our liabilities in order from current to long term. Then we can get to our owner's equity now. We start off with our capital balance. So Walton Capital, a credit balance of $55,000. Then we have the Walton withdrawals. And that was a debit of $4,000. Then we go to our revenues and our expenses. So we have service revenue. And our service revenue right now is $16,600. Okay, then we have all of our expenses that we have to go through here. So we'll start off with salaries. A debit balance of $3,800. Then we had rent expense, and that was for $1,300. Then we had utilities, and that was for $180. Then we had advertising, and that was for $1,700. Then we had some supplies expense in our adjustment process, so we know we have to include that now, $1,000. We had insurance expense in the amount of $300. Interest expense of $50. And finally, depreciation expense, equipment of $150. So I believe that gets all of the accounts there included. Let's see if we can get this all in one area here, or close to it. Down one more notch here. Okay, so let's total this up. So we go here, we sum, and we hope we come out, and we do. $87,080 is our total debit column and credit column. Let's put a dark line up here so we know that we're equaling that up. And we know that then we also want to do a double line underneath of our adjusted trial balance totals. Okay, so that concludes step 5. We did the adjusting entries, we posted them to the T accounts, and then we prepared an adjusted trial balance. So now proceed to watch the next video, which will be a lecture video on how to do step 6, which is the preparation of the financial statements, and then we'll come back and we'll do the financial statements for this problem.